Welcome to Investor Hangouts. Investor Hangout is a joint initiative of Aditya Birla Sun Life Mutual Fund and Value Research. Roughly 3 years back, we started this initiative to spread awareness about the investments and address the anxieties and queries of the investor. Today, we are thankful to our viewers. It is our 100th episode. As we reflect on our journey of Investor Hangouts, we realize that it is an overreaching theme attaining the financial independence that runs across the queries received over the last 3 years. And so we decided this time we can cover 3 parts on focusing on financial independence. And today it's of the first of such episode, which is talking about the millennials, how they can handle their finances and financial independence. With me, I have 2 important speakers who will be taking the queries at the end of this session. Mr. Dhirendra Kumar, CEO of Value Research, and our CEO, Managing Director and CEO, Mr. A. Balasubramaniam. And thanks to both of you for being here.
Thank you.
And it's great to have both, and it's a 100th episode. It's definitely the most important episode and a milestone for us. At Aditya Birla Sun Life Mutual Fund, we are proud to have this episode to move on. And to start with, I'll have my first question to Mr. Bala. Bala sir, we have My First Paycheck is a theme we run at an investor education initiatives, and I'm sure some time back you had your first paycheck, and which was always special. And looking at how long back you got it and what did you do with your first paycheck, did you get a advisor who is advising you like the way you are today, and what was you reflect on it?
Very interesting actually. That's first paycheck in the early 90s, late 80s when I got into the job. And salary levels are not as high as what we are seeing today. It's very small value in relation to what we are seeing today. The first paycheck naturally in those days, as we all used to practice, as we were advised by our own parents, and the first paycheck went to God, right? We call it the hundi. So maybe it was such that it could help us multiply your own income as we progress in your life. But again, then comes is the savings, and the childhood days, especially, the parents always have the habit of investing through the recurring deposits, and that's the way in the early days it used to work. And if you convert that into an SIP, I still have an SIP which is still carrying a value of 400 rupees in my own books, which is called payroll savings plan, and I subscribed when the company had given an option to subscribe an SIP. So I broke it 1,200 rupees into 3 parts, 400 rupees to ILSS schemes, and rest of the 800 rupees into various equity schemes. Those SIPs are still continuing, and that's the way I did it. And believe me, it only got multiplied. You start with small amount in SIP, you continue, then as your salary level increases and keep increasing in SIP. Therefore, SIP has become part of my portfolio.
That's phenomenal to understand from you. Probably the SIP now in your pocket, which can shake us. You're walking the talk. We are very glad. Dhirendra, learning from Mr. Bala's investment as the first paycheck, and even the asset allocation which has happened way back, 400, and but I was watching most of your episodes on Hangouts, and you always preach about starting early. I mean, sometimes starting early may be difficult, but what is that reason you said start early of your investments?
Primarily, savings is a habit. So, and it is not a function of scale. And people find a lot of it. And today, finding excuse not to save, you have just too many. One is, the first and foremost is that, why save? Have fun. Because savings is postponed consumption. Why do it in future? Why not spend it now? So the pleasure of spending the money now, that's one. But besides that, there are many excuses. One is that, I don't know how to go about doing it. Or when I will have more money, then I will do it. Right now, there is absolutely nothing. 500 rupees mein kya hoga? It starts with that. I will have some meaningful. Then I don't know, and some expert knows it. And till I find that expert, these are usual excuses. But you don't get to appreciate the magic of compounding, the joy of the magic that happens with 5,000 rupee going. I would say that somebody who has no access to even market should start with something, irrespective of whatever without knowledge, without understanding, without the understanding of whether he's getting into a balanced fund or something, or an equity fund. Don't get into the complication. Get started anyway. Doing it with your small money, you understand 2-3 things. One is that you are able to accumulate something which you didn't have in the first place. The power of compounding that you see. And third is, when you do it at an early stage, it helps you, postpone some of the trivial spending that happens, some of the casual, you understand the worth of money. And so the magical impact, and that habit, once it gets formed, then it is very difficult to reverse it. It's exactly the opposite of the habit of spending. If it is formed very strongly, it will be very hard for you to save. So the reverse is just as true.
That's nice, Dhiren. I mean, probably what you can say is it inculcates a discipline, and it will also help them to beat the inflation to get that regularly. And this is the one which is they can invest every month. That becomes a habit.
Yeah, early stage is all about appreciation of the fact that this is a good habit, and you will be independent. It gets you dignity, having and immediately you start getting recognition in indirect forms. That you will have all your friends or all people around you, and you will be a better off person. You will actually feel that you'll feel more confident simply because you have your own savings and you don't have to depend on others for anything meaningful.
I think it's phenomenal. I mean, I really appreciate the way we should start. But when Bala said you started your first investment itself from your first paycheck, starting early is important. I think it's the right way to start. But right way to start with the right asset allocation. But when you started, you bifurcated into 3 investments. But probably what you suggest the millennials today, what kind of right asset allocations, right to start, but what is the right asset allocation they can look at?
See, I think millennial itself is a reflection of that is a young age, is a youth, and he has a long innings to play when he gets to the job. Right? That means he has the long life to earn his money. So, and therefore, it's like creating a company for generation. And when you have such kind of investment opportunity, naturally your allocation towards equity has to be a lot higher when you start. So, for 100% of the money that as a millennial, as Dhirendra mentioned, that you have your own needs, and then you need to build your basic needs at the time of getting into the job and spend that money. At the same time, you need to also start saving it, as we mentioned about start early investing. So naturally, you have a long innings to play, and then when you have a long innings to play, you don't need to worry about market fluctuations. Second, you need to worry about the age. You don't need to worry about the retirement, which essentially means that money is for long term and go into equity. 100% of the money you should put it in equity and keep saving it every month in equity and keep it for long term. That's the only way the millennials can create wealth in the long run. Having said that, as you get older and as you get a little bit of high level of maturity, and then as you come closer to 40, as you come closer to 50, then you can keep taking your allocations depending upon what your aspirations, what the goals are being met. But at the end of the day, millennials have long innings to play and play it with the full equity investing.
That's a nice, Bala. I mean, there is an acronym which people talk nowadays is financial independence to retire early. That is, they call FIRE, FIRE. And as you rightly said, these millennials got a fire in them, and probably they can put more into the equity and they can get back. Exactly. But the challenge comes here, Dhiren, and we come across, we go across the colleges and we do the programs and we meet the first time employees. And the challenge for them is, the first priority for them is to buy the latest gadget rather than start the investment. How do you guide them? What is that they need to do? Whether they need to postpone their consumption or start their investment?
No, not postpone their consumption. You will have, it's a very unusual situation because one is that people getting started now, they start with a decent income. They don't have to struggle through, earlier, 20, 30 years back, what Bala was referring that he got his first salary which was not very, very sizable. Today people start their career when they have surplus, which means they are in a position to save. And but at the same time, the avenues to spend has grown substantially, and the easy available credit made available by buying things on credit card, buying things on EMI. Sometimes you go to a shop to explore something, and the guy is tempted to give you the loan without much of a documentation, so that you can come back joyfully with the stuff, in your car or on the rickshaw or something. There are companies which are actually thriving on this impulsive purchase, big ticket purchase sometimes with short-term loans. But that kind of, and I don't think there is a clear demarcation that what is right, what is wrong. It could be important, getting a refrigerator for a young family on an EMI could be fine, but you have to decide. But more importantly, everybody thinks in terms of spending the money, and whatever left will be saved. To form a habit, I think it is important. Whatever it be, make a conservative estimation, 10%, 15%, 20%, 25%. But that is the money which you have to save and invest before you start spending. Because if you don't form this habit, it will never, you will keep waiting. The procrastination is one of the biggest problems for investors to accumulate something meaningful from their investments.
I think it's a very useful tips which you gave. Probably the save first and then start investing, then start spending on that. But do you mean to say that they should have one kind of a financial plan, or they need a right financial planner for them, or how you suggest, how they can go forward, how you can simplify for them?
If they don't have a plan, and if they don't get a financial planner, this is good enough, because having something is better than not having anything, or finding a due date on which you will get started. That itself will postpone things. But there is a hierarchy of things. One is that how to go about doing it. If you do these 2-3 things, one is the money which your emergency money, that should be handy. It depends on your own configuration. It could be in your locker, it could be in your savings bank account, or in a liquid fund, depending on the complexity of your family structure or emergency anticipation. You can do that. That should be the first priority. Health insurance, because number 2, because that is something which can derail all your savings plans. Somebody's bad health, hospitalization can completely, put it off road. Third is, if you have financial dependence, definitely have the term insurance, because till you accumulate your net worth, you will not have enough to cover your family. So term insurance is the finest way, possibly cheapest way for a young person who has no net worth to get the cover for your family when it might, just in case they need it. And then after that, what Bala said, invest for the long run, invest in equity. And even if you don't follow asset allocation, but if you don't follow asset allocation, then you have to follow one more thing. Invest and forget for next 3-5 years. Don't look at it every day. And you'll be taken care of.
It's a very holistic approach. Thanks, Dhiren. But Bala, when you said they need to invest in equity to start with, like for them, equity is a better option for the long term. But they may have some other goals. Maybe they're getting into the married life. Probably we can deal in the next episode, which we talk about how you suggest an hybrid fund for them.
See, hybrid fund, it in some sense it takes care of your asset allocation. So that is essentially, it has some bit of fixed equity component, and it has a fixed income component. In the equity market, when it fluctuates, sometimes people do have questions that got too much money lying in the equity, and therefore should I create a cash, and vice versa also will happen. So that normally takes care in the hybrid fund. Again, as Dhiren mentioned, you have to, whether it is hybrid fund, which is equity oriented hybrid funds, then you have debt oriented hybrid funds, and both the funds can actually act as an alternate to either an equity investing for a high focus equity orientation hybrid funds, and high focus debt funds can actually fulfill the needs on income needs, and both I think have to be looked at from a longer term angle. Any investment that you make, whether it is equity or a hybrid fund with high equity exposure, or a hybrid fund with high debt exposures, or a debt funds, you have to give a minimum of 3 years and go as long as possible in order to get the best experience.
Thank you so much for that, Bala. I mean, I look at hybrid fund could be another way where they can look at auto allocation is happening for them. And this millennial have a habit, fill it, shut it and forget it millennials. Probably you just start investing in hybrid fund, your SIP every month, then you can just forget it and it will accumulate and it takes an auto allocation. As he said rightly, this will also get into a mode where over a period of time you have a long-term wealth which they are creating it, and it's and you also suggested a liquid fund for them, their emergency fund.
Emergency fund, liquid fund, or you know, even the debt-oriented hybrid funds can well be, because you know your emergency fund may not, you know, the emergency may not be there for a long, you know, it could well turn out to be long-term investment. At the same time, all mutual funds are liquid. You get your money in 1, 2, 3 days. One should have a hierarchy for your emergency fund. Money which should be in the locker, money which should be in your wallet, money which should be in your bank account, and then the money which should be handy when you need it at a day's or 2 days notice.
Yeah, I think thanks to both of you for that, and indeed we did discuss a little bit of how can make the entire job of investing easy for millennials. Probably the guidance from you coming is start investing from the first paycheck and make a simple plan where you can start implementing. You can start even with a hybrid fund and have an allocation to equity that way auto mode, and get a liquid fund and take care of your dependents and take care of your parents and have an health insurance which you spoke about it. Anything else you want to suggest, Dhiren?
Start now. Most people, you know, it is good problem to have that you have accumulated and your investments are not doing well. But if you don't start now, you won't have any problem. You just won't have the money. So start now. Don't find excuse. And you know, these hybrid funds are a great way for somebody who is uninitiated, because you know, you normally have people who are historical fixed income investors. They have only invested in PPF, or they have been in government service, or you know, their only deduction has been public EPFO. So they are not used to the market, you know, how markets behave. Markets prove to be very rewarding, but in the short run they prove to be very devastating. They're very unnerving. You put your 100 rupee and sometimes you see that, oh, it has gone down to 78, and then you start worrying about it, and then you are driven out of the market. The way to actually experience it is in a manner so that it becomes acceptable to you. Balanced funds are a great, you know, way to do that, because you are able to take a very steady take on growth. Your money grows well. 70% of your money is in equity, but it doesn't really collapse the way equity does because of that 25-30% shock absorber of fixed income, and that makes it little more acceptable to people. So don't find, you know, for your long-term money, give up on the excuse. Start now, and because you know, there are many excuses that will come your way. One is that after you have convinced of all this, then you'll say that let the market get fixed a little bit and then I'll start investing, or market is too expensive, or it has just gone up too rapidly, or now it has gone down so much. So people just keep waiting, you know, forever, and then you know, the money is idle. Then you have the spending avenue. So all these things, get started now, stick to it. I think one more thing which should be, you know, kept in mind is that once you have been able to form this habit of whatever 10%, 15%, 20%, people think of investments in terms of they're doing some kind of essential duty. No, you are actually doing a very important thing of taking care of your, you know, accumulating for your future income needs, or you know, money when you'll stop earning. With that in mind, everybody thinks in terms of constant. Like Bala was saying that he has been doing this much rupee of SIP for all these years. Why a fixed thing? Because his salary would have gone up by 50 times. Why not that saving component? If you think in terms of percentage of your income going towards that, or your investment component growing at a certain pace, then I think, you know, that will be fair to yourself, and that will not be a very hard thing to do. So one is get started anyhow with a balanced fund, and then increase your investments over time.
Thanks, Dhiren, for that remarks, and start now, don't postpone. This is the last question to you, Bala. How do you suggest most of these millennials, when we look at, they're a bit confused on their tax planning because they just got into the employment and their taxable income. Do you feel ELSS can play a vital role for them, and your closing remarks around it?
Yeah, I think clearly, as I mentioned earlier, that he has a long innings to play. At the same time, every individual today comes in tax bracket because of high earnings that they have. Definitely, tax planning has to be one of the way of investing. Second is for saving tax, and third is for creating alpha in the portfolio. All the three are very important. and therefore ELS schemes play a very important role compared to any other option that they have today of equal tax saving it gives you, but from a wealth creation point of view, it serves both the purposes. Definitely the mutual fund ELS schemes serve the purpose. I think my simple advice, as Dheerendra mentioned, the one common question remains in everybody's mind. When the market falls, you wait for the market to fall further to make investment. When the market goes up, you are waiting for the market to come down to make your investment. Both the say keep looking for market to fall for you to make investment, and never comes. Therefore, starting without worrying about, without giving excuses is extremely important. Second is when the market goes ups and downs, your return doesn't reflect in the portfolio naturally, because ultimately everything is linked to the market. And most of the people actually do look at the market value, and suddenly they realize I invested last year and are not making money, am I making the right investment? And the very fact that when at that time of investing, you thought about investing for 5 years, 10 years and 20 years, just by looking at the market, you will make mistakes of stopping your SIPs, although one should not do. And sometimes it does occurs in the minds of people, whether it's millennial or non-millennial, even the mature investors, they do go through this confusion. Therefore, I would suggest, one, don't worry about market fluctuations, start early, continue your investment, and don't monitor that closely for you to take any kind of decision which will keep you away from the goal that you have in mind. I think keep this in mind, and I'm sure the success will come.
Thank you so much, Bala. Today, glad we have two individuals with a very rich experience of little over 25 years of experience. Each of them carries with us, and it's a great wisdom they share for the millennials. I think I'm sure this episode will be very useful for most of the millennials to follow. And Dhiren, thanks again. Thanks, Bala.
Thank you.
And we have few questions around this episode which are coming in, and some of them millennials coming from the various professions. I think the first question which has come from a doctor, and it's like this question, I'll put it to Mr. Bala. Bala, here is a question from Mr. Mishra. Doctors usually take slightly longer to start earnings because of their studies. Should they make any specific changes in the financial plan because of the delay in they get started, since you said they should start early?
Yeah, I think the income starts because till the age of 30, 32, all doctors are busy in studying and preparing for the next round of building their own career all the time. The real earnings for them starts maybe after 32 or 34. Of course, you apply the principle of your age minus your 100 minus age, that determines your allocations. At that point of time, you should not be too conservative in choosing schemes which doesn't give you the longer term wealth. Therefore, that principle has to be applied even at the age of 32 or 33 when you start receiving your paycheck or the income starts coming to you. Apply the same principle and then go for it. And that's something very important. Second is their income, depending upon what they do, the income can fluctuate. Somebody who practices, income can fluctuate. Therefore, they should build very high discipline of saving this money the day they get this money in their hand. Most of the time, the doctors keep the money in either in cash or in the savings account, not deploying that money judiciously into schemes that can generate them a longer term return. So therefore, they need to also pay attention. But as they get my income, they need to also look at T minus to the day they get their income. Within 3 days, they need to not only just deploy in the bank, they need to also look at their investing opportunities apart from what they plan actually for the spending. I think these are simple discipline. If they are able to keep it, I am sure it will help them in building a good portfolio that could help them in the long run.
Thanks, Bala. I think it's good they take care of health of the people, but they need to take care of wealth of themselves. Thank you so much for that advice. Dhiren, here is a question from Shipra. It's a question what she says is, would you suggest buying a car loan, or what portion of the total cost should I pay as a down payment? So far you are talking about investments, here is something about spending.
Depends. If you can do without a car for a while and you can start saving and investing in a manner that you can buy your car it is actually a reverse EMI. Instead of borrowing money to buy a car today, if you can postpone the buying of the car and start investing, so as if you are paying the EMI and accumulate money and also the appreciation, there are two advantages of it. One, it is eminently possible because if you are living in any of the leading cities in India, you can actually enjoy a car without buying one today. It is possible. with the Ola and Ubers, you don't have to necessarily buy cars. Then of course, there could be, there could be a need. If there is an urgent need, by all means go and take a loan, buy it. But if it is not a very urgent thing, then do this reverse. Accumulate your money and you will save on the interest. And every purchase every buying that you do based on borrowing, you have to see that whether it is a consumption or whether it is an asset. And on that front, so I would say that borrowing money is justified only in two cases. One is emergency. You land into a hospital and you need the money and you have to take the money or borrow money on the credit card or from your friends or anything is fine. The other is a home loan. You are buying an asset which will appreciate, it will save you rent and it will also get you a tax break. There is no third kind of borrowing which is justifiable. One should try and avoid or configure his consumption or spending so that you never have to borrow. There are some borrowings which you should never do, because no investments ever generates the kind of return and the kind of interest that you incur on that, which is the credit card loan. It's amazing that people end up spending 30% per annum or sometimes 36% per annum, and they don't even notice it.
Thanks, Dhiren. I think the next question I'll have it to Mr. Bala. Bala, it's a question from Mr. Niladri. He says, why is it not recommended to periodically book profits in SIP?
Interesting. See, SIP itself is creating a portfolio for your longer term need. And then if you start confusing that investing for long term is one side is the goal, other side I would also keep booking a profit. The profit is going to again go backfire. Again, it has to go back to the investment unless you have a spending need. And therefore, these two don't go together as a concept. Having said that, the allocation of the SIP you put in equity, and then as time progresses, one has to start paying attention to hybrid funds, you start paying attention to conservative hybrid funds such as MIP schemes, and then start paying attention to interest rate bearing schemes, which is the fixed income schemes. That's where I think asset allocation comes in. So while do that in SIP, build your longer term portfolio, any profit booking in the mutual funds has to come in the nature of moving from one asset class to other asset classes, and that's called rebalancing of your portfolio. Has to be on an ongoing basis, maybe at the interval of 6 months or maybe at the interval of 1 year. It just review your portfolio and see how does it work. And then profit booking should always come only if there is a real need to move out of the investment and have some spending needs. I think if you keep that as a principle, money can move within the same mutual fund schemes, which provides 4 different type of solutions, which I generally call it as 4 solutions. For saving solutions, there are the liquid funds. For income solutions, there are fixed income schemes. For wealth creation, there are equity schemes. For tax solution, there are real estate schemes. You can actually use all the 4 different type of mutual fund product, which come from every mutual fund, can be used actually for your asset allocation model, and that itself will help you in booking your profit needs and at the same time move on in asset allocations.
That's a very good answer, Bala sir. It's you are very simplified how the millennials can look, not only at the question answers to the Niladri, but it's how they can look. There are 4 ways, 4 buckets they can keep, and that mutual funds can serve their entire purpose of wealth, tax savings to the wealth creation side. Probably mutual funds are their mutual friends in their life to grow and create the wealth. Here is again a question to you on EMIs, Dhiren, and it's a question from Deepak. He says, is there is a way to avoid EMIs? I generally end up with them after impulsively buying gadgets, and it so happens many a times for many of us.
No, if you remain impulsive, there is no way to avoid EMI. But there is a way you can deal with not being impulsive. Change your way of life, change your friends, and change the kind of YouTube channel that you are following, which is the gadget review and other things. And always remember your this particular thing, which in the earlier part I was not able to tell it with as much clarity. If you buy things you don't need, you will soon sell things that you need. So, and when you sell things that you have bought which for consumption, they don't get you anything meaningful. You take a car from a showroom and you try to sell it, you will fetch 20% less, 30% less. You get a phone, expensive phone, and in 6 months time it is an outdated phone. So think about your impulses and think about, and also do a little bit of, so change your friends, because it's normally the peer pressure which drives you to do that, or not, don't change your friends, but reconfigure your friends, or read something else and resist this.
Thank you so much for it. Probably it's a good answer. Hope Deepak, we have answered your query. Probably the Dhiren says is you move from one EMI to other EMI, not the paying the monthly payment. Probably the equity monthly investment, which Bala suggested, that is a SIP. That could be your new EMI. And here is a question, Bala, for you. It's a question coming from Mr. Amit. I am saving significant part of my salary to fund my MBA, which I want to do abroad. I am planning to go abroad after 2 to 3 years. Where should I invest my money?
So I think somebody is saving for going abroad, which I would also assume it comes, again, what age you started. And if I am planning for it's my own education, so I am not planning for down the line 20 years, 30 years, maybe down the line say 2 or 3 years. If my parents plan for kids' education, definitely they plan for the educations after they attain the age of 18, then goes down to 22. That means you have a, I would assume, long period of planning. So I think it depends upon what kind of segment of the people who are actually planning the saving. If it's young age, go for an equity. If you don't have too much of time, I think you are just planning it in the later part of your teenage and for your higher education going abroad, then we are left with only 4 or 5 years for you to make the savings and build a corpus actually for overseas savings. Then one has to go for fixed income. And there you cannot afford to take the risk, but that money is coming back reasonably in a reasonably good quantum for you to meet your needs. I think is more important. And that money cannot be invested in either in equity, which will probably go through ups and downs. It cannot be invested in PE fund. It cannot be invested in real estate fund. Then it has to be invested only in the fixed income schemes. So depending upon how long you are planning to give that for your investing, and that will determine which scheme that you need to go for.
Thanks, Bala. It's like you say to them, depending on the time frame, you invest what kind of assets you want to get it. Thank you so much for it. And here is a question, I think looks like is a question from Mr. Rajan. Looks like he has invested his money. I mean, the question says, how safe are credit risk funds and long-term funds and gilt funds right now? Can they be preferred over fixed deposits at this point of time?
No, if you are actually looking at a comparison with fixed deposit, none of it will compare with fixed deposit. They all come with their configuration or a a component of risk and return of different kind. Like gilt funds, they have no credit risk, but they are exposed to the market risk. If interest rates go up, they will go down, and they go down quite dramatically because gilts are also available in very long term, have very long term. You will have 10-year, 15-year, 20-year government of India bond. If interest rates go down by 1%, they can actually collapse by 10, 15 or 20% as well. So nothing is risk free. They all come in and it's important to understand that how do you actually prepare yourself to take the risk in a measured way. And if you are strictly comparing it with FD, then you limit yourself to ultra short term bond fund, liquid fund, because there is also an advantage there. Those funds will get you fixed deposit kind of return with very small likelihood of they going down in value, and they will be more tax efficient. They will provide you superior liquidity. So if you want to have a strict comparison, be there. Credit risk fund, they assume they are supposed to, the name itself is a little scary, that credit risk, so you're taking risk. But basically they are lending it to companies to enhance your return, and the fund manager does a job of reducing your risk or assuming or evaluating your credit in a manner that he is least exposed to the risk. But still, you never know. And the benefit of mutual fund definitely plays a role there, that if you invest, if you put all your money in a company deposit, and if your money if the company gets stuck, then all your money goes down the drain. If you invest in a mutual fund, then a small part of your money disappears, and being a going concern, you realize it, and maybe there will be a superior realizability over a period of time. So strict comparison with FD, limit yourself to ultra short-term bond fund and lower.
Thanks Bala, thanks Dhiren for being here at the 100th episode. It's very meaningful and it's very profound, and 100th episode is coming at this point of time where we have two celebrities to answer. And before I think I can have some concluding remarks on 100th episode, it is I can only show some statistics to the people. We have 25, you have answered 25,000 questions in 100 episodes, 100 episodes, and we have 6,50,000 people who have registered for this, and we have over 3 million people who are watching it over a period of time. But what is your experience, Chase, around it?
Oh, I need to really highlight 2-3 things. One is that 25,000 questions. I'm quite impressed that we have dealt with so many questions. But more importantly, when this 100 episode of Investor Hangout is an example of start somehow. Because we talked about Investor Hangout and it took 6-7 months, and then one fine day I thought that let me do a extempore monologue, and that is how Investor Hangout started. I just sat in front of a camera and started answering questions and talking about a hot burning topic that day. Second thing is that a lot of people say that Investor Hangout is talking the same thing, and yes, we talk about 10-15 things. And why we talk about the same thing? Because these are very simple things. It requires reinforcement. It requires repetition. It requires, it requires repetition in a different context. People were asking very different kind of questions. Tell me the hottest small cap fund 1.5 years back, and how to reduce their losses in small cap funds, and moderating the, Investor Hangout has played two important things. Played a very critical role in two things. One is moderating people's expectation in a crazy market, and telling them to have courage and reinforce the thought that think for the long term, and it is important to invest through the lean time, and appreciating all the risk of investment, because any investment you will have to take measured risk, and being measured about it, we help you measure it well, appreciate it better.
Phenomenal, congratulations. And
thank you for enabling this.
I think credit goes to my CEO, MD and CEO, Mr. Bala, whose brain's child is have this Investor Hangouts, and today it's turning out to be a great initiative from us. And thanks for watching us. Probably we thank all our viewers for patronizing Investor Hangouts every alternate week. Thank you so much.